Well, I can tell you this. I mean, this type of action is just not comforting. I don't think anybody's going home feeling like they got this thing nailed.
Mike Wilson is the Chief Equity Strategist at Morgan Stanley, which is just a fancy way of saying that he's the big shot for analyzing the stock market and making predictions about what will happen in the near future. And while I, of course, love doing my own research, reaching my own conclusions, and investing in individual businesses, I also really enjoy listening to different macroeconomic perspectives, whether it's from Ray Dalio, Michael Burry, or in this case, Mike Wilson. And beyond the prediction that he makes in this CNBC clip, which is that the markets are going to fall another 10%, there's actually a lot more to learn about what is driving the markets at the moment. So in today's video, I'm simply going to be sharing this latest clip from CNBC. It came out yesterday. I'm going to break down some of the financial jargon, so some of the more confusing things he says. I'll explain what he means. And throughout, I'll also be giving my opinion as a Warren Buffett Munger style value investor. Just before we get into some of the clips, today's video is sponsored by TIKR. If you're looking for a comprehensive tool to assist you in your fundamental analysis and research of stocks, then TIKR is basically all that you need. You get access to full global coverage of thousands of stocks with detailed financial statements, charting, analyst projections, and more. You can track guru investors, screen for stocks, and even track insider trades made by company executives. Check out the free or pro plans by heading over to tikr.com/Hamish Hodder. That's TIKR.com/Hamish Hodder. And if you head down to the description below, there's also a special deal that you can check out that's only available at the moment.
Morgan Stanley's Mike Wilson joins us on the Fast Line. He is the firm's chief U.S. equity strategist and chief investment officer. Mike, always great to get your viewpoint.
Thanks, Melissa. Great to be here.
You know, I asked all the traders this question. I'll start it off with you. Glass half full or glass half empty in terms of the action in today's market?
Well, I can tell you this. I mean, this type of action is just not comforting. I don't think anybody's going home feeling like they got this thing nailed, even if they bought the lows. So, I mean, this volatility has just got to settle down. But it makes sense why we're seeing this type of price action. We do have this collision between tightening Fed and slowing growth.
In this first part, there's a couple of major things that Wilson says that I think are important to note. The first is that he says essentially that the price action recently has been unsettling. What he's of course talking about is if you're trying to trade stocks in the short term, get in and out of stocks based on charting and other technical indicators, it's been a difficult time over the past couple of weeks. Now, as a long-term investor myself, I am not a trader. I have no interest in trading in and out of businesses. I simply want to accumulate wealth in great companies. And honestly, whenever I see a drop like we've seen over the past couple of weeks, so the market's come down over 10%, I don't feel unsettled. I actually feel really excited because what it essentially means is that these great companies in the market are getting cheaper and cheaper. And even though they might not be at a price yet that I'm willing to invest in, I know that as markets continue to fall, and if that gains momentum, there's a very good chance that some really great companies will be available at good prices. The second thing he says in this first clip is that the reason why the markets are falling at the moment is because we're seeing the collision between higher interest rates and lower growth in earnings of companies on the S&P 500. I think this is absolutely correct. And those two negative factors on the market, lower growth and higher interest rates, are actually both caused at the moment by the same thing. That thing is inflation. As I've spoken about recently, inflation is extremely high at the moment, 7% in the US, 5.4% in the UK. And that higher inflation is forcing the Federal Reserve's hand in raising interest rates. And they're also quickly cutting out their $120 billion per month money printing, which they've been doing since basically March of 2020. And how inflation actually produces lower growth in most businesses is because high inflation means that costs, typically for most businesses, are going to be rising faster than they can increase their revenues. Now, some businesses will be able to raise their prices on their products or services and make up for some of the increased cost that they're seeing on the supply side, but most businesses won't be able to do that, resulting in smaller profit margins and ultimately less growth over the next year. Remember, it's really only businesses that have a distinct competitive advantage or an economic moat, as Warren Buffett would call it. It's only those businesses that are able to consistently raise prices and protect themselves against the cost inflation that they're seeing within the business. Because ultimately, if a business doesn't have something unique, if the product or service isn't something that customers must buy from that company, then if they try and raise prices because their costs are going up and to protect their profits, that customer is just going to substitute for a different product. It's only businesses that have something that is unique, some kind of competitive moat, that will be able to raise prices and protect their profit margins, continue to grow in this inflationary environment.
The reason we're doubling down on kind of the defensive side is because we think the slowing growth narrative is the one that's going to become more important. It's not a recession or anything like that, but look, we do think there's going to be a payback in demand this year. We do think margins are a potential issue. We've been talking about this for months, it seems like. And we think the market is going to focus on this. So that does lend itself to owning companies that have earnings, stability, visibility, and achievability relative to expectations. That's where the valuation comes in. And that's how we're set up. And quite frankly, it's been working really well since, mid-November. And we're going to stick with it because I don't see that dynamic changing just because we had a big sell-off and a rally today.
In this section, Wilson goes on to say that they are actually setting up with a lot of defensive stocks in their portfolios. What he means by defensive stocks are the kinds of businesses that sell products and services that people buy consistently regardless of kind of what economic conditions are going on, whether they're negative or positive. So those businesses that see very, very similar revenues and profits over time, things that are essential for customers to purchase, like groceries or utilities, for example. As a result, those kinds of businesses will be a little bit more protected by inflation because people are going to be buying those things in similar amounts regardless of what's going on. Now, those businesses aren't going to be completely immune from inflation and higher interest rates and that sort of thing, but they're a little bit more protected than, say, cyclical businesses, for example. And I can give you an example. Thor Industries, which is now the second largest position in my portfolio, they're a recreational vehicle manufacturer or a caravan manufacturer. And they are basically the complete opposite of a defensive stock like a utility company. They are extremely sensitive to inflation and interest rate increases. And that's simply because if the cost of living goes up for consumers because inflation is rising, so the cost of food is going up, utilities, housing, then customers are less likely to spend a lot of money on something discretionary like an RV. They're likely to cut out those purchases. And on top of that, to stack another problem on top of that, rising interest rates means that for something like a caravan company, where most people buy them with financing, use debt to kind of pay for a $100,000 RV or a caravan, because interest rates are going up, that means that's like another cost that's going up if you want to purchase an RV. And those things mean that Thor Industries and other RV companies and other cyclical companies will be very, very sensitive to the changes we're seeing in the market at the moment. So you might be wondering, does that mean that you're trying to sell Thor Industries and buy it back at another time? Well, no. And the reality is, the reason why is because while we can kind of look at what people are predicting about what's going to happen with inflation and interest rates in the future, we ultimately don't really know what's going to happen. So if I was to sell Thor Industries, I would essentially be making a macroeconomic bet that inflation is going to continue to get worse and that interest rates are going to continue to rise. I don't know for certain if that's going to happen, so I'm not going to trade in and out of a great business. If they do get hurt in the short term because of this, I know that there's still a great business over the long term, and as a result, I will be very, very happy to scoop up more shares, increase my ownership in a great business while the stock price is down.
But you're predicting a fall for the S&P 500 below 4,000 in the next 3 to 4 weeks. So what do you think is a catalyst? Is it just getting the clearer picture from corporate America that margins won't be as good as you say? I mean, what do you think, precipitates this?
Yeah, I mean, part of it is I'm hoping for that trade below 4,000 because, look, my upside target, my base case is 4,400 for year end. So, if I think that's the case and I need something below 4,000 to get really constructive. So I do think it will happen. I think it's a combination of the Fed continuing on this course. They're doing their job. They're not going to back off because the market sold off a bit here. And the data really hasn't been soft enough for them to stop the tightening process. That's going to go forward. And then the second thing is around growth. Now, part of that will be earnings and guidance around 22. This will be the first time companies have done that. And I think some of them will take this as an opportunity to maybe lower the bar a bit because, look, it's a tough operating environment. And then the third thing is the macro data. Look, the macro data has softened up, whether it's retail sales, PMIs, the companies that are doing these surveys. They're not feeling as constructive as last year. Once again, it's a difficult operating environment. So a lot of those metrics just have to come towards us and what we're predicting. and then we'll feel better that it's fully priced.
So then we get to the prediction. He thinks that the markets will fall another 10% on the S&P 500, and he really gives 3 reasons why, although one of them isn't really a reason. The first thing that he says is that he needs a 10% drop because the current S&P 500 level is actually his prediction for where the market will be at the end of the year. So he's essentially saying if the market doesn't fall 10%, then it's going to be flat. He expects it to be flat from here, and he has no room to make a positive return. Even though he poses this as the first kind of reason why, that's not really a reason. Obviously, the market doesn't care about his portfolio and his performance, so it makes absolutely no sense to include this in a reason, although I guess he was kind of just putting this out there. Then he goes on to give 2 actual reasons, one of which makes sense to me and the other which I don't think really makes any sense. The first reason is that he thinks that the Federal Reserve is not going to back off on monetary policy. They've obviously been tightening monetary policy to tackle inflation. And with the markets falling now, they kind of have a choice. Do we protect the markets and slow down our tightening? Or do we continue to be aggressive and get inflation down? That's kind of the trade-off that the Federal Reserve has to make right now. And Mike Wilson believes that the Federal Reserve will continue to be tight, and they're going to get tighter, and that they will try and push inflation down, and they won't really care if the market reacts negatively to it. I have no idea if this is what's going to happen. I think this is what should happen, considering inflation has been outside of the 2 to 3% desired range for, well, since April of last year, so an extremely long time now. We're at 7%. It's still going up. So inflation is a big problem at the moment, and if I was the Federal Reserve, I would be jacking up interest rates right now, regardless of what impact it has on the markets. But we'll see what happens. Tomorrow there's a Fed meeting, so we'll kind of get to see how they're feeling about the current correction in the markets and whether they're going to react to that. And then his third reason was around guidance. So a lot of companies haven't given forward guidance for the next quarter, for the next year, since March of 2020. They've kind of cut their guidance because things were so uncertain. So we're starting to see companies give guidance again for the first time. And Mike thinks that companies are going to be really, really conservative, really, really reserved on their projections, and that the market will view that negatively. This right here is really just him making a guess about how investors will react to short-term earnings. I don't think you can predict short-term earnings. I don't think you can predict how investors react to that potential short-term earnings or guidance. So I don't think that's something you can consistently predict. I think it's pointless to include that in your investment process. So I certainly disagree with him on that. Well, I don't disagree with him. I just think that there's no way you can know how investors are going to react to guidance given over the next few weeks. And that was basically it from the clip. He goes on to say that, well, someone asked a question, so where should people put stocks? And he said there's some high quality tech names that have come off, healthcare, other defensive like utilities, consumer staples, and REITs. You know what, I don't kind of invest in that way. I don't look for specific sectors. I'm much more interested at looking at an individual business and assessing the relationship between what I'm paying for it and the cash that I get back. And the one thing I would agree with, I think tech is getting better. There's obviously a lot of highly speculative tech stocks that are available. I'm not talking about those, but good quality tech companies that have deep moats and great management teams, they're at least starting to come off. I don't want to invest in them. I think he calls them, he says that they're expensive, but they're not really expensive. So to me, that doesn't really mean I want to invest in. I don't want to buy something that's just not insanely priced. I want it cheap. So I think they're getting better. We will just have to see what happens with the markets over the next few weeks. If things continue to worsen, particularly if inflation does pick up, we don't know what's going to happen with inflation, but if inflation picks up and the Fed has to be tighter, if they have to pull back their money printing even faster, if they have to raise interest rates more aggressively, then we may very well see a more significant correction. And that's exactly what you want if you're a value investor like me. I'm going to be mostly buying stocks over the next 20 or 30 years, so I want them as cheap as possible. And for most people watching this video, that is going to be the same situation. But that's all for today's video. I hope you guys got some value out of it. Leave a like if you did, and hit subscribe if you want to stay up to date with content that I post in the future. It is really hot in here. I hope I'm not too red or sweaty because with this light. This light is massive and it's just so hot, and I think it's like 35 degrees today. So I made it to the end. I'm gonna go have a nice cold glass of ice water. So I hope everyone has a great week, and I'll see you in the next video.